Every investor talks about diversification: stocks, bonds, maybe a little real estate. But the most sophisticated investors know diversification alone isn't a strategy anymore. In today's world, it's about designing income. That's where private credit comes in. One of the most effective ways to generate consistent yield, lower volatility, and add structure to a modern portfolio. In this episode, we're going beyond diversification to explore how professionals and family offices are using private credit and private debt to build income that's engineered, not guessed. After the 2008 financial crisis, lending changed. Banks slowed down. Regulation tightened. But the need for capital didn't stop, and investors still needed income. That's when private credit began its rise, quietly becoming a $1.7 trillion global market. It offers yield that isn't tied to stock market emotion, with returns designed through structure, collateral, and negotiated terms. And it's no longer just an institutional play. Professionals, physicians, executives, entrepreneurs are now using private credit as a strategic layer in their portfolios. Let me show you two examples. Meet Dr. Lisa, a 52-year-old orthopedic surgeon.
My practice was thriving, but my investments felt stuck. Half my portfolio was in equities, the other half in muni bonds, steady but uninspired. And every year I'd face a big tax bill. It felt like I was working harder than my money. I was introduced to a private credit fund that focused on asset-backed lending. You know, secured loans tied to commercial real estate and equipment finance. It wasn't something I'd considered before, but once I understood the structure and risk controls, it just made sense. So then I decided to reallocate some of my assets, about 15%, roughly $1.2 million. It wasn't a huge portion, but it made a huge difference. My yield more than doubled, from about 4 to 9%. My income became monthly and consistent. And thanks to the depreciation benefits, my tax exposure improved too.
Real change wasn't on paper, it was psychological. She went from reacting to markets to owning her outcomes. That's the magic of private credit. It transforms income from unpredictable to engineered. Then there's Mark, a 48-year-old tech executive who sold his company and wanted to put his liquidity to work.
After the sale, I wanted my money working, but I didn't want the constant ups and downs of the public markets. I'd seen how volatile things can get, and I was looking for something more stable and predictable. So we built a private debt portfolio focused on direct corporate lending and short-term real estate bridge loans. It targets around 9 to 11% annual yield. To me, it's a next-generation bond replacement. It plays the same role fixed income used to, just with more efficiency and better risk-adjusted returns. The cash flow's steady, it's not tied to market swings, and every loan is backed by real collateral. And honestly, I don't see this as an alternative anymore. This is how institutional money actually works.
Exactly. And now it's available to disciplined private investors too. Lisa and Mark came from different worlds, medicine and tech, but they share the same realization. Real wealth isn't about chasing opportunity, it's about designing predictability. Private credit and private debt have become core building blocks for investors who want consistency, structure, and control. This isn't about speculation, it's about strategy. It's about creating yield you can plan around, even when markets don't cooperate. Because confidence doesn't come from guessing, it comes from positioning. Private credit is no longer a secret of institutions. It's a key part of the modern wealth conversation, and one of the smartest ways to turn capital into clarity. If you'd like to explore how private credit or private debt could fit into your portfolio, I'd love to connect. We'll look at which strategies align best with your goals, risk profile, and tax plan. Because in today's market, control isn't optional, it's strategic. If you enjoyed this episode, please subscribe and let us know you like what you hear. It helps us reach more investors who think the way you do, strategically, deliberately, and outside the box. And we look forward to seeing you next week for the next edition of Investing Outside the Box. I'm David Harris. Thanks for listening.